Welcome to CoreLogic's housing market update for September 2021, brought to you on behalf of Westpac. Despite many parts of the country remaining in some level of lockdown, the housing boom continued to roll on, with national home values rising another 1.5% last month. The rate of growth remains strong across most areas of the country, but we are seeing mounting evidence the growth trend is losing some momentum. The 1.5% rise in August was actually the softest monthly outcome since January this year. The slowing rate of growth probably has more to do with worsening housing affordability constraints than ongoing lockdowns. Housing prices have been rising almost 11 times faster than wages growth over the past year, creating a more significant barrier to entry for those who don't yet own a home. Lockdowns are having a clear impact on consumer sentiment. However, to date, restrictions have resulted in falling advertised listing numbers and, to a lesser extent, fewer home sales, with less impact on price growth momentum. It's likely the ongoing shortage of properties available to purchase is central to the upwards pressure on housing values. The latest update takes Australian housing values 15.8% higher over the first 8 months of the year and 18.4% above levels a year ago. In dollar terms, the annual increase in national dwelling values equates to approximately $103,400, or about $1,990 per week. In comparison, Australian wages are rising at the average annual rate of 1.7%. This is the fastest annual pace of growth in housing values since the year ending July 1989. As a quick retrospective, in the late 1980s, the annual pace of national home value appreciation was as high as 31%, so the market isn't quite in unprecedented territory. The annual growth rate at the moment is trending higher. In fact, it's 3.6 times higher than the 30-year average rate of annual growth. Capital city houses are continuing to record a stronger growth rate relative to units. However, the performance gap does appear to be narrowing. Throughout the first quarter of the year, capital city house values were rising at approximately 1.1 percentage points faster than units each month. By August, the average performance gap had reduced to 0.7 percentage points. The convergence of growth in house values and unit values could be another demonstration of affordability becoming more challenging, and it's most noticeable in Australia's most expensive city, Sydney, where the monthly growth rate for houses was 2 percentage points higher than units in March. That gap has now reduced to 0.6 percentage points in August. Based on median values, Sydney units cost almost $470,000 less than a house. Turning our focus to supply and demand, both advertised supply and housing demand have been negatively impacted over recent months. In early May, newly advertised properties were tracking almost 20% above the 5-year average. However, due to both lockdowns and seasonal factors, the number of new listings through August dropped to almost 6% below the 5-year average, and total active listings were closer to 30% below average. The estimated number of home sales has also been impacted, dropping by 9% nationally over the 3 months ending August when compared to the previous 3-month period. Despite the fall in sales, housing market activity remains at well above average levels. Although there has recently been a trend towards fewer buyers, the past 3 months has seen the number of home sales remain 30% above the 5-year average, at a time when active listings are 29% below average. Clearly, there is still a disconnect between advertised supply and housing demand, even in the cities where lockdown restrictions are active, which is keeping upwards pressure on housing prices despite the challenges faced by both buyers and sellers located in cities with mobility and social distancing restrictions. Strong selling conditions can also be seen in auction clearance rates and private treaty measures. Auction clearance rates have trended lower, especially in Melbourne, where a large proportion of auctions have been withdrawn from the market. However, where properties have proceeded to auction, the large majority are recording a successful result, albeit with a large proportion selling prior to the auction rather than under the hammer. Similarly, the median number of days it takes to sell a property is showing a mild upwards trend. However, most cities, including those navigating extended lockdowns, are continuing to see homes selling in 30 to 35 days or less. At the same time, vendor discounting rates remain at record lows, implying vendors aren't budging much on their initial pricing expectations. The housing trends across each of the capital cities remain diverse. The most visible impact on Sydney's housing market as it navigates the extended lockdown is the decline in advertised stock levels. New listings added to the Sydney market have fallen from being 36% above average in early May to almost 13% below average by the end of August. Total active listings were 22% lower than average at the end of August. The decline in available inventory is another factor supporting the upwards pressure on housing prices, where through August we saw housing values rise a further 1.8%, taking the market 20.9% higher over the past 12 months. In dollar value terms, Sydney dwelling values have risen by approximately $180,000 over the past 12 months, or about $3,460 per week. With housing becoming less affordable, the rate of growth across the Sydney market has been progressively easing since March, when housing values rose at the monthly rate of 3.7%. Melbourne home values have continued to push higher despite the ongoing lockdown and restrictions preventing physical home inspections or on-site auctions. House values rose by 1.4% in August to be 15.6% higher over the year, while the unit sector has seen a milder rate of growth, with values up 0.5% over the month to be 7.3% higher over the year. Weaker conditions in the unit sector can also be seen in the higher number of listings. At the end of August, total active listings were trending lower but remained 8.1% above the 5-year average, while house listings were 15.1% below average. Higher listing numbers across the unit sector reflect less demand for higher density housing options, along with a lower than normal level of investment activity and a recent history of newly built supply additions. Higher stock levels imply more choice and less urgency for buyers and less upwards pressure on housing prices. The Brisbane housing market is showing less evidence of slowing price appreciation, with the monthly rate of growth holding around 1.1% to 1.2% month on month since May. Brisbane doesn't show the same affordability challenges as the larger cities, which may help to explain the persistently high rate of growth, but also fewer outbreaks of COVID and a strong interstate migration tailwind supporting housing demand in the absence of overseas migration. Brisbane housing values are now 18.3% higher over the year, which is a similar result to the national average, where housing values are 18.4% higher. The number of home sales across Brisbane over the past 12 months is approximately 41% higher than the 5-year average, while total active listings are 30% below the 5-year average. This significant gap between available supply and demonstrated demand is another reason for the consistent lift in housing prices. Adelaide has recorded one of the highest monthly and quarterly growth rates amongst the capitals, with housing values up 1.9% in August to be 5.3% higher over the past 3 months. The local unit sector continues to weigh on the pace of growth, with unit values rising by 1.6% over the rolling quarter, compared with a 5.9% increase in house values. Over the past year, house values have risen at more than double the rate of units, rising by 19.8%, while unit values are 6.4% higher. This trend towards demand for lower density housing options is something we're seeing in most of the capital cities. Adelaide home sales have surged by 32% over the past 12 months relative to the previous 12 months. Such high demand has been a key factor in pushing active listings 32% below the 5-year average, adding to the sense of urgency buyers are feeling amid such high demand for a small pool of available properties for sale. The Perth housing market remains strong, although we have temporarily withdrawn our home value index for Perth and regional WA this month. We can see the strength in other aspects of the market. Home sales over the past 12 months were 60% higher than the previous 12-month period and 50% above the 5-year average. At the same time, active listings are about 28% below the 5-year average. The byproduct of such a strong level of demand and low supply is that homes are selling very quickly, averaging just 25 days on market with minimal discounting from vendors. Despite such tight housing market conditions, Perth housing values remain relatively affordable compared with the other cities. The median house value, at just over $555,000, is the lowest of any capital city, and the median unit value, at $405,000, is the third lowest after Adelaide and Darwin. Hobart continues to record one of the fastest rates of capital gain, with housing values moving 2.3% higher over the month to be 24.5% higher over the year. Hobart is one of the few cities where unit values are appreciating at a faster pace than house values. The local unit market is up 27.1% in value over the past 12 months, compared with a 23.9% rise in house values. The strong performance may relate to demographic factors, where a more mature age market is now seeking out low maintenance or smaller properties, or it could also be related to the worsening affordability challenges in the market. Over the past 5 years, Hobart housing values have increased by 69%, which is by far the largest increase in housing values over that time for any capital city. The pace of growth in Darwin housing values has started to ease after a stellar run of growth through the first half of the year and second half of last year. Darwin home values were virtually flat over the month, but have risen by 22% over the past 12 months. In line with the surge in housing values, the number of home sales has also jumped higher. 2,472 dwelling sales were recorded over the past 12 months, which was 57% higher than a year ago. Despite the significant increase in values and volumes, Darwin housing values remain almost 16% below their 2014 peak, and the number of home sales are also well below historic highs. Canberra housing values are up a further 2.2% in August, taking the annual growth rate to 22.5%, which was the second highest rate of annual growth amongst the capitals after Hobart. Similar to many of the other capitals, the house market has returned a much stronger result than the unit sector. House values are up 25.7% over the past 12 months, while unit values, where supply has been higher and demand lower, have risen by a much smaller but still strong 10.9%. The recent lockdown has seen Canberra listing numbers move sharply lower at a time when seasonally listings would normally be rising. At the end of August, the trend in new listings was tracking 24% below the 5-year average, and total listings were 34% below average. With demand for housing remaining strong, it's likely lower advertised supply levels will continue to support the upwards pressure on housing prices. Australia's housing market appears to be navigating the uncertainties associated with the Delta outbreaks, much the same as we've seen through previous lockdowns. Supported by low advertised stock levels relative to buyer demand, housing values are continuing to rise, albeit at a slower pace than earlier this year. Inventory levels have fallen sharply across the cities where lockdowns persist, but more broadly, advertised stock levels remain low across the country as demand continues to outweigh supply, resulting in a rapid rate of absorption of new listings. The volume of home sales has trended lower, mostly due to restrictions in Sydney and Melbourne, where the number of sales is estimated to have fallen by 19% and 34% respectively when compared with the prior 3-month period. Rules associated with physical property inspections are stricter in Melbourne, which probably helps to explain the larger reduction in sales activity. With spring arriving, we would normally start to see new listing numbers ramping up. And there is some evidence of this happening in Brisbane, in Adelaide and Perth and Hobart. However, the same cannot be said for the cities where lockdown restrictions remain in place. The trend in new listings remains weak in Sydney, Melbourne and Canberra. Housing market activity bounced back quite quickly following previous spot lockdowns and after Melbourne's extended lockdown late last year, and we are expecting a similar turn of events once restrictions are eventually lifted. There is likely to be an element of pent-up supply that's unleashed when restrictions ease, which should see inventory levels rise. Arguably, there's greater uncertainty about whether demand will rise at the same level following lockdowns. Affordability constraints are likely to progressively dampen housing market activity, and further down the track, there's also the potential for credit tightening to have a negative impact on demand. A lift in advertised supply, in the absence of more buyers, could be another factor that weighs on price growth later this year. The trend through spring will be highly dependent on what happens with COVID and associated restrictions. Any signs of an easing in restrictions should see a rise in advertised stock levels as the delayed spring listing season gets underway. However, a worsening or broadening of the outbreak into other states will of course have some downside impacts. As always, we'll be monitoring the intra-month trends via the research pages at corelogic.com.au.